Hey guys, how's it going? Brian Burns here with the Master Key Group at RE/MAX Downtown, and we're talking about the fundamentals of real estate investing. Now, first things first, if you have not seen episodes 1 through 3, please circle back and then go check those out. That is where we have laid the foundation for really everything that we're going to be building on for the rest of the series. Now, we are talking over the last few weeks about the different types of real estate products that you can invest in. So just like if you were going to go invest in the stock market, you would want to probably do a little bit of research on what particular companies to invest in that are going to help you reach your goals. That's exactly what we're doing here with these different types of real estate products. So what we've gone over so far has been single family, multifamily, townhouse, condo, luxury, and then new construction. What we're going over today is one of the big things. Everybody's into it nowadays, especially once things get on HGTV and all that. It really starts to catch traction, but it is a very lucrative business, and that is short-term rentals. All right, so we're going to go over the pros and cons, and then from there we're going to go over an actual live example. I was blessed with clients who are actually also accountants, so they kept very meticulous books, and they were nice enough to share everything with me, just for you guys, so that way you can see the actual carrying costs and the actual net income that one of these properties can bring to you. Okay, so first things first, let's do the pros and cons. First thing is that you have a very high earning potential. That's why a lot of people get into this in the first place, right? You have a variable POE, which is point of entry, and it really is the sky's the limit. So you can purchase property starting in the mid 200s, and you can really go up to 3, 4, 5 million plus. Okay. Now, you can use it yourself. So unlike these other products that we've talked about where it's long-term rental, if you have a luxury home and you've rented it out for the year, if they leave for the weekend, you can't just pop in and use the pool, right? Well, the nice thing is with these, if you don't have a booking for the weekend, you actually can. It's your home still, and you can still go there, okay? Now, there are a lot of different earning models. So this is not just you take the home, throw it on Airbnb, and see what comes in. There is a ton of different types of ways to earn money. A good example would be for somebody who wasn't looking for variable income, because from month to month, your earnings are different depending on how many guests you get, how much you charge per night. So if you did not like that kind of variable income, some companies will actually pay you 8% of the purchase price every year. Okay, now so that means that you have a set income, and what they're hoping is that they can make more than that and then kind of pocket the money that they're making over that 8% that they're paying you. That is just one example, but there are tons of different ways to make money, but kind of the industry standard is you get it and you throw it on Airbnb, right? Now, the other thing is you have 75 million reasons why. So 75 million people came to Orlando in particular, which makes it an amazing market. It is a huge area. You have Disney, you have SeaWorld, you have tons of conventions. So there's just so many people coming into the area. And a lot of people, they think, well, maybe this is oversaturated. The crazy part is that these short-term rental homes actually only make up about 5 to 7% of the short term. So between hotels and everything like that, there's only about 5 to 7% of it is made up by short-term rentals that are privately owned. Okay, so it is a very unsaturated market with a huge earning potential and a lot more room to go up. And then you also have a nice potential for a down payment of 10%. So this would be for someone who is buying from out of the area, buying into the Disney area. Now you can actually you can do a 10% down payment. And this is great for somebody who may not have all of that startup money for the 20%. Really, it's literally half of what you would have to bring to some of these other options, okay? Now, some of the cons, now whereas you do have high earning potential, you do have fluctuating earnings if you choose to do it on the Airbnb style. So you may have months where you might even break even, maybe even lose a little bit of money, and then you have other months where you might make $2,000, $3,000, okay? Now, it can be globally affected by global factors. The biggest example is COVID-19 right now. We literally had our state Airbnb shut down for, I think it was just over or just under 2 months. So that can obviously, be very disruptive to your business. The great part about it is the flexibility of the use of these properties. Now, if you were to do an 8% model where they would pay you 8% over the year, then you're set to go. The other thing is that if you don't have people checking in, a lot of these places actually just rented them out for the year, and they're doing very well. They're renting them out for $2,000, $3,000, $4,000 a month. So there is a good earning potential, and they're very flexible in their use, right? That was the epitome of adapt and overcome, right? So they do have, generally speaking, higher carrying costs when you're buying in these communities that are set up to be like vacation rental communities. They're going to have the pool, tennis courts, concierge. They're going to have a lot of these things, which is going to result in higher carrying costs for you. But the other thing that you may not consider is that when you do a long-term rental, all the utilities and everything, the cable, all of it gets switched over to the person who's renting it, the tenant. Well, in these cases, the tenant is, they may be there for the week. They're not switching everything over to themselves for the week. So you're going to be holding on to all the utilities, the cable, the pool companies, all those different things. So you are going to be responsible for paying all of those. So there's a lot of moving parts with these, and we'll go over that on the next part of this. Now, they are, generally speaking, difficult to maintain on yourself. So a lot of my clients, they come in, they have very high hopes of like, we're just going to do this ourselves. And for the most part, your day to day is more or less easy. The last thing you want, though, is that you're in an important business meeting, or you are, at your kid's dance recital and you have 15 missed calls because the person who is trying to check in can't get into the house, and now you've got a bad review on Airbnb, or they can't find the blender or the air conditioner. They don't understand how to use it. So, on the day-to-day, yes, it's not too difficult, but those little outliers can be very disruptive to your day. So generally speaking, it's much easier just to use a management company. Now, your startup costs can be high. So if you were to buy a new construction property, you got to remember, you still have to furnish it. You got to put all the furnishings into the house. Now, when you do resale, actually most of them already come furnished, but they may come furnished with stuff that was in there, has been in there for 10 years, 15 years even, and it might be time to freshen it up, okay? The other thing is that they are, generally speaking, a little bit harder to sell, and that's for a number of reasons. So people that are coming looking for a vacation home, a lot of them, yes, they're looking to use it for themselves, but the bigger thing is going to be that income. So they are going to be looking for the deal. And these properties, their main value is more so the recurring income rather than the final sale, that big increase in value generally, okay? But not only that, you have to consider the people who are buying these vacation homes, they're also traveling, a lot of them. They're buying it, if they're buying it for themselves, they may be traveling in from New York and they're in for the weekend. Well, if you've got guests over that weekend, then you're not going to be seen. So they might buy another property, even if it was not as nice as yours, they may end up buying that one just because they were able to see it and you had guests, okay? So that can be a little bit disruptive to your sales process, right? So what we're going to do is we're going to go over the property that my clients purchased, and it's this one here. All right, so that's the home they purchased. Now let's go over the numbers. All right, so we have our purchase price, $404, down payment 20%, $80,400. Closing costs were nothing because the builder paid. This is new construction, so the builder paid all their closing costs. But with new construction comes some of the startup costs of $30,000, which is furniture, starting your own business, getting your business license, everything like that to operate it as an Airbnb. So our vocab word, total cash in, $110,400. Now we have our carrying costs. How much does it cost us to run business on a monthly basis? Now these short-term rental homes have a lot more carrying costs than a standard rental property, because really with a rental property, you might have your HOAs, a pool company, lawn company, and your mortgage. This one has a lot more though, you'll see. So you have your standard PD, principal, interest, taxes, and insurance. You have your HOAs, which generally speaking are a little bit higher because you're buying in a resort-like community. So they have resort-style pools. They may even have a golf course, tennis courts, things like that. All right, and then you have your pool cleaning, and then you have your standard cleaning. So depending on how many people check in and out per month, you have to pay every time someone checks out. So if you have 3 guests that check in 1 month for a long time, or you have 7 guests who check in for a shorter period of time, it's going to cost you more when you have those 7 guests checking in and out, okay? Then you have your management fee. Now this is their specific example, okay? So this isn't a standard, but for them, what they did is they had a $145 per month management fee. Now what they did was a little different and somewhat unorthodox, is that they worked out with their management company to where they would joint manage it. They could do bookings, but then they would also have the management company do bookings. The management company would make a % commission off of the bookings that they brought in themselves, okay? It's not standard, but like I said, there's 1,000 ways to, there's 1,000 models to make money with these things. All right, and then you have your H2O, your water, electric, pest, and cable. Now electric, that's something that will vary from month to month, right? It'll vary from season to season as well. So what electric companies will do is they'll often allow you to have a standard electric bill. So during the winter months, you might not need as much electricity versus in the summer months to cool that place. So rather than that, they just give you a straight across the board electric bill, so that way you don't have these very big varying electric bills. Now, our monthly carrying cost, $3,590. Now, you see an asterisk here, and you see an asterisk for this one. This is your carrying cost, including your principal and interest. Now, for one of the things that we're going to use as a measurement, you don't include principal and interest. So that is that number there. Multiply these by 12, so that way we have them ready for the other side where we bring income into it, okay? Now, income varies, and that was one of the cons of it, is that you have, the pros and the con. You have a very high earning potential, but you have a variable earning potential, right? So what I did is I highlighted 2 lows and highs for you just so you could see how the difference is. So in October, they had an income of $2,700. The occupancy was at 45%, and then the average nightly dollar amount was $198. Now, generally speaking, August, September, and October are slower times of the year. That's why, they do a lot of like Disney dining. They'll do Halloween Horror Nights. It's really kind of a way to bring people in on a generally slower time period or, timeline. Now, so for December, they had an income of $5,600 and change. That's almost a $3,000 difference from one month to the other. They had an occupancy of 74%, and their average dollar per night was $244. You got to think December, you have Hanukkah, you have Christmas, you have the New Year. So there's a lot of people who are and then not only that, but they're getting charged top dollar because it's such a high demand, right? Now, what we need to do now to really figure out what our return on investment is we need to take a whole summary of 2019. We can't just take little snapshots of one month to the other. We need to take everything and add them all together, all right? Now, their average dollar per month was $5,000. Their average occupancy was 77%. That's pretty good. So remember, we said 75 to 85 is really your sweet spot as far as your occupancy. A lot of people think, well, I want as close to 100 as I can get. Well, not really though, because you want to have, if it's above that 85%, that means your product is too cheap and you can make more money per stay or per night. And then if it's below 75%, that means that your product is too expensive. And if you just lowered your price just a little bit, you might be able to work yourself into that threshold and make more money. Okay, so it's all about finding that sweet spot. I told you there's a lot of moving parts when it comes to these. This one is one of the more in-depth kind of business models as far as real estate investment for sure. So your average dollar per night, $202. Your gross total income, $60,000. Okay, so that's your gross income without taking out any of the expenses. So what do? We need to take out our carrying costs. Now the carrying costs do not include principal and interest. Okay. So the reason for that is because if someone was to come and purchase the property, you would want to show them how much money that they're going to make without a mortgage involved. Because them coming to buy the property, they could have 1,000 different ways that they're doing the mortgage. Maybe, or they may not have a mortgage at all. They may pay cash. They may put 50% down. We put 20% down. Maybe our interest rate is really high and that interest rates are lower now, so they could get a better, a better price. So what we need to do is we just need to show them for our cap rate, our carrying costs, and then how much a property costs. So we use it as if you paid cash. So what we do here is we have our expenses, we take those off, and our net income, $34,499, okay? Then what we do is we take, as if we paid cash for the property, we take 404 and we take 30 and add those together because this is part of the cost, okay? So 434,000, all right? So 434,000, and then what we do is we take 34,499, divide it by 434,000, and then your cap rate sits just at 7.9%. Okay, that's pretty good. Like I said, I've said it in past episodes, is usually investors are looking anywhere from 6 and up as far as cap rates go. Okay, now when we look at our annual principal and interest, we take this number here, all right, multiply it by 12, and we get this one here. So we subtract it from our net income. This gets us, this is a vocab word we haven't used in a while, our before tax cash flow, because this includes what's called our debt servicing, okay? So now our before tax cash flow, $17,099. This gives us our cash on cash return. How much money are we making and how much money did it cost us to make it, okay? With our cash on cash return, we take our before tax cash flow and then divide it by how much money it costs us from the jump. So we take 17,000 and change, divide it by 110,000, and that gives us 15.5% cash on cash return, okay? So that was a lot of information, I know, because these short-term rentals are very in-depth. It's one of the more complex models for doing real estate investing. But like I said, with that comes more money. So they're a great investment opportunity. And if you guys have any questions, obviously leave them down in the comments, and I'd be happy to answer them. I'll talk to you later. Bye.